Here's something that should bother you more than it probably does. Your credit score determines whether you get approved for a mortgage, what interest rate you pay on a car, even whether some landlords will rent to you. And yet almost nobody actually understands how it's calculated. That's not an accident. Banks and credit bureaus make money specifically because most people never fully understand this system. Once you see how it actually works, you'll realize the rules you've been following might be quietly keeping your score lower than it should be. I'm David, and this is Dollar Horizon, where we break down the financial systems that were never designed to be easy to understand. If you've ever felt confused about why your credit score moved for no obvious reason, stick around because this is going to make a lot more sense by the end. Hit subscribe if you want more of these breakdowns. Most people think their credit score is mainly about whether they pay bills on time. And sure, that matters. But payment history is only about 35% of your score. The other 65% is made up of factors most people barely think about. Factors that banks and credit card companies benefit from you not fully understanding, because confusion keeps you doing things that generate them fees and interest. Here's the part that surprises people most: credit utilization. How much of your available credit you're actually using makes up roughly 30% of your score, almost as much as payment history itself. And here's the detail banks really don't advertise clearly. It's not just about paying your balance off every month. It's about what balance is showing on your statement the day it reports to the credit bureaus, which often happens before your payment due date, not after. This means you could pay your credit card off in full every single month, never carry a balance, never pay a cent of interest, and still have a lower score than necessary, simply because your statement happened to show a high balance on reporting day. Most people have no idea this timing detail even exists, and banks have very little incentive to explain it clearly, because a slightly lower score keeps some people reaching for credit-building products that generate fees. Let's put real numbers on this. Credit experts generally recommend keeping utilization under 30% of your available credit, but the people with the highest scores usually sit under 10%. Here's a concrete example. Say you have a credit card with a $10,000 limit. If your statement closes and reports a balance of $3,000, that's 30% utilization. Not terrible, but not optimal either. If that same balance was $800 at the exact reporting date, you're under 10% utilization, even though you might have spent the exact same amount of money that month. This single detail, the timing of your statement date versus your payment date, can shift your score by 20 to 40 points in some cases, without you changing your spending habits at all. That's often the difference between qualifying for a good interest rate on a loan and getting quoted a rate that costs you thousands of extra dollars over the life of that loan. Here's another detail banks rarely explain clearly. Closing an old credit card, even one you never use, can actually hurt your score. Length of credit history makes up about 15% of your score, and it's calculated using the average age of all your accounts. Close your oldest card, and you don't just lose that account's individual history. You drag down your average account age across your entire profile. People do this constantly, thinking they're simplifying their finances and unintentionally lower their own score in the process. Banks benefit from this confusion too, because a slightly lower score sometimes pushes people towards secured cards or credit-building loans that come with their own fees. Here's the pattern across all of this. The credit system rewards people who understand its mechanics, not necessarily people who are the most financially responsible in a general sense. You can be completely debt-free, pay every bill on time, and still have a mediocre score simply because you didn't know about statement timing or account age. Meanwhile, someone who strategically manages these small details without spending any more money ends up with a meaningfully better score and access to better rates. Now, to be clear, none of this means you should open a bunch of new credit cards or manipulate your spending in unhealthy ways to game the system. New credit inquiries and new accounts temporarily lower your score too, and chasing small optimizations while ignoring the fundamentals, paying on time, keeping overall debt low, will backfire. This is about removing unnecessary self-sabotage, not turning your finances into a science experiment. So here's the real takeaway. Your credit score isn't just a report card on your character. It's a system with specific mechanical rules, and most people are graded on a curve they don't even know exists. Understanding when your balance reports, keeping your oldest accounts open, and knowing exactly how utilization is calculated won't cost you a single extra dollar, but it might be the difference between a good interest rate and a bad one for the next decade of your financial life.